Good morning, folks. How are you? If you would give me a audio check on Twitter, I'd appreciate it. Audio sounds pretty good on my end, so you should be okay. All right, there's our opening price. I don't have a whole lot of expectation this morning, but I'll sit with y'all. I was going to defer a live stream until this afternoon, but I have plans that I wasn't aware of, according to my wife. Gentlemen, you know how that works. Um, so that prevents that from happening. So I'll just hang out with y'all this morning till about 10:30, and then we'll break again. Got a lot of feedback from yesterday's lesson. Appreciate that. Trading View is really lagging. Just being quiet. The audio is fine. I had a couple guys say that they couldn't hear me yesterday talking as well, so I'm not sure. That's on your end. It's a little too smooth. ES is a bit of a mess. Let's take a quick look at Dow. Oops, wrong one. There's decoupling. It's pretty expected actually when there's no news due out that morning, or this morning rather. And NASDAQ. See how they're going different directions? That makes it a lot harder for precision to be available to you. Doesn't mean you can't trade it, just means that you're trading with lower probability. I've done it before, but if you're a new trader, a new student, it's not something you should be trying to do. All three of the averages should be moving together. If it's a trading asset that you're, like for instance, I'm monitoring NASDAQ on the regular. So if that's my asset class, I want to trade as the indices for stock indices, and the specific instrument being the NASDAQ, I look for the S&P and the Dow to be moving in the same direction. If I'm wanting to be long, I want to see something that's supporting the idea for all three of them to be bullish. I'm watching this little gap right in here. I like the idea that upper portion of that gap not being traded to. ES is making a lower low. Let's take a quick look at that. Let's come out on a 15 on this. There's your sell side there. I'm not going to label it because I don't really care so much about this one. And Dow is just a mess. Q. If it runs for the sell side, it's just going to be one of those instances where the first percent of fair value gap doesn't give you an entry. And you remind yourself that it's decoupling. It means there's the mixed direction on all three averages, Dow doing its own thing. But great for journaling. It reinforces the idea of being highly selective on the days that you want to enter, what the sessions that you want to enter on. You want all the things going for you in your trades instead of just looking for any old thing to get me into a trade. That's a 20-year-old ICT's version of trying to trade. If it was oversold, that was enough reason. It's enough reason to get in there now. I'm watching this volume imbalance. Now, the question probably comes up in your mind is, okay, if you're noticing now that indices are doing different things, one index going one direction, the other's doing the other direction. What does that mean for me as an analyst? What does that mean for me as the trader? What does that mean for action? Where's the actionable ideas on that? Well, you have a choice. You can sit and wait for the indices during the morning session to either come together in terms of agreement, or they start moving in tandem. Sometimes that happens in the same session. Sometimes it takes the morning session to sort all that out, and over the lunch hours, then the afternoon becomes a little bit better to trade. Or it can, on the worst case scenario, it can stay decoupled all day and make very problematic conditions for trading. Unless you're really, really short term and you're just taking the lightest, the things that would instigate you taking the trade, the smallest of things to do that, which I'm not a fan of. I don't teach that anyone should do that. The more things you have in your favor, the better. But these are actually better. These are better teaching environments because nobody wants to talk about these types of days. They want to talk about when they made money or when it was easy for them. And that's the easy part of learning, and that's the easy part of being a teacher, when it's easy. Everything looks like it's perfect. But when you're met with the realities of what the market's going to give you, sometimes it's going to give you a curveball where you're not getting all the indices in agreement. Let's take a quick look at Dow once more. I would not want to trade that. That's nothing there. It's really it looks like cheap bubble gum. All right, so we look at the ES. So far, the only thing that makes sense, even though it's not in agreement with any of the other two indices, NASDAQ still looks okay. And I'll go over what I mean by that. We've been weak. We did not get a return back into first percent of fair value gap. That's fine. We have bearish order block, trades up into here. Notice the bodies inside this gap. The bodies stay right at consequent encouragement or lower. These are the damage inducing events where the wicks are allowed to do that type of damage. And then we roll back down, rotation out of the volume imbalance. Even with the decoupling, I would like to still see that sell side deliver. But then because it's mixed, I would like to see some kind of return back into the range, which is likely to see it come back under here. That's a scenario I'd like to see. I would see it trade down into sell side, explore a little bit lower than that, and then if it can make its way back up in here, I would look for, as long as the Dow stays basically an unruly brat doing what it wants to do, and if the NASDAQ shrugs off any weakness as well, back up into here, going into the second half of the AM session, that would be something I would look for. It doesn't mean it's exactly what I'm looking for. I'm looking for a scenario after seeing the sell side deliver like it just did here. One of the best things you can do is give yourself permission early on is to let trades pan out when it's highly unlikely for precision to be there. So we can still see elements to the things I teach, but these are the types of little things that'll probably mess you up, because you could probably look at this and say, okay, ICT said he liked this fair value gap. So maybe some of you pushed the button. If you did, you failed, because even though it did deliver where we're looking for sell side, it doesn't mean that you should have taken that trade, because if you've listened, even though it's done this, it's not a high probability trade. That means that these are the types of setups or movements in price action that I'm comfortable sitting on the sideline and just watching them paint and tape read them, watch them, observe them, go over them with my son if he's sitting next to me, or send screenshots to them and say, hey, look at this, see what it did here. Not being a participant in it. These types of scenarios happen all the time. But the very, very choice setups for you to get in, they're not as frequent as these are going to be. And that's the problem with impatient traders. Impatient, undisciplined, without a model, without a protocol or procedure that they follow, or a high demand on quality setups where everything is in agreement. Let's take a quick look at the Dow once more, see if it's changed anything. I'm still working on one screen because I want to, again, emphasize the importance of, look at that, so it's going the other direction. And then ES, let's take a quick look at that. No real expansion on the downside, but it still has its sell side right there. So I would venture to say, let's take a couple things here and note them. Volume and balance right in here. I'm just going to make it with a rectangle if you don't mind, just to save some time. So again, that it has sell side down here as well. Okay, and back into NQ. As you can see, a rather anemic opening range gap again. And it just so happens that the first fair value gap forms actually in that same area as well. So we have taken sell side on a mixed decoupled AM session during the opening range. We have a couple more minutes still for the first 30 minutes to book. Now, two scenarios on a morning like this where the averages are doing different things. Dow's going up, NASDAQ best performer on the downside, and then you have the ES that is moved a little bit, but it hasn't quite made the same type of delivery for its sell side down here yet. So it's being, like I said, it's snubbing any weakness, as I was indicating earlier. Like I want to see if it fails to go lower. If it does that, it's going to run for the buy side here for ES and maybe explore the orders up in that area there. Not that it needs to know how many orders there are, but that's where the buy side would be. These two lows, these two highs, with this one being lower than this one. And then this high over here. Let's back it out a little bit. And you see these really clean little, almost too perfect, isn't it? So if it fails to go below the sell side, NASDAQ tries to come back up into its range. That would be where my eye would go to for ES, but it's conditional. So notice I'm saying these things have to accompany other things. It's not just simply me saying ES is going there. We'd still have to work out the uncertainty of this sell side being taken or not in agreement with the NASDAQ returning back up into its range. That would indicate that this could potentially become an inversion fair value gap if that is what is likely to see unfold. And that may support a run back up into maybe the first delivery to first of the fair value gap and back into the opening range gap, which is kind of sharing the same real estate in terms of price range. And I'll go back out to regular trading hours just for a moment to show you what I mean by that. So we have the settlement price here yesterday. I'm just going to use it with the lines if you don't mind. And we'll annotate with this. Oops. opening price today. Okay. And then we can go back out to electronic trading hours. So you can see there's two frames of reference in here. We have the first presented fair value gap that never got traded to yet, despite being delivered to the downside and sell side. It did not get traded back into here after creating it. So this candle never made it up there, and no subsequent candle after that made its way up there. So the consolation prize was that we could see this fair value gap forming here. And the bodies were laid down and buried right at the consequent encroachment of that separation between this candlestick's low, that candlestick's high. And the wicks were permitted to do the damage. So this is just simply returning back into these two consecutive up-close candles, where because they're two consecutive up-close candles, you use the opening price of the lowest. That's this one right here. That's your order block or change in a state of delivery, where price was delivering buy side. That means it's moving higher, and then it changes and goes lower. So change in a state of delivery is that opening price, and you can see it going right there, and it returns and trades lower. Just for good measure, it turns right back to this candlestick's low as well. Look at the low of that, 20,307 even, and the high comes in 20,307.25, which is a perfect delivery to this candlestick's low plus 1 tick per spread. One more quick look at the Dow. Again, being a brat, doing what it wants to do. And ES. Okay, let's extend this out a little bit more. See, we've already hit it there. Watch the consequent encroachment of this wick. See, I'll hit that right there. And in a perfect world, it would roll out of this and go down and attack its sell side liquidity. See how it's very, very difficult to frame any kind of stop loss in all this if you're trying to be short. So that's one of the things that you're just going to have to accept that there are going to be times where you're not being afforded a very low risk entry or an entry at all, despite knowing where it might potentially still trade to. And in the beginning, as a student of price action, especially learning from me, it's real easy to get caught up in the frenzy of trying to use something you just learned, especially if you see our community members that are sharing their immediate success with something that they just watched me outline and teach for the first time, or maybe amplify something that they thought they understood, and now they're like, okay, now I have a new breath of life and interest around something I used to like, but I haven't been playing around with it too much. And then you see them doing something that makes them profitable or shows a profitable endeavor using it. So that means you want to go out there and you want to try to do it right away too. And you'll lose focus and not recognize the opportunities that are not being afforded to you because you're just wanting it to go to a draw on liquidity. And that's not enough. You have to know that this market climate where there's a decoupling where the three averages are doing opposite things. They're not doing the same thing. Okay. That was a neat little turn back up into the opening price there. Hammered it perfectly. There's nothing in here to frame an entry on. So the only thing we're really watching and observing is, does it have the ability to rotate out of this and attack the sell side, which is the only thing that makes sense down here. Doesn't mean that it can't go higher. It just means that if it does, who cares? You wouldn't have been short because there's nothing in here to frame it for the risk. There's no way to feel good about taking the trade because you have decoupling. So I'm speaking to the folks that are trading ES, by the way, because I have a lot of students saying, you never talk about ES. Why don't you like ES? I like the volatility and the price delivery in NQ because NQ is a little bit more exaggerated. It's only 100 stocks versus 500 stocks. That makes its composite index up. So S&P is a little bit slower. It's a little bit like it's kind of like cognac. I'm not a drinker, but it's like a cognac. And ES is kind of like Johnny Walker or Jack Daniels. Okay, you want to get your ass tore up real quick, you drink the cheap stuff, and you can drink a lot more of it. And it's fun. It's fast. It's an easy, good time. But if you don't know what you're doing, it can wreck you. ES is a little bit more sophisticated. It's a little bit more well-rounded. Okay, and the uh, the interest in volatility is my number one concern for trading because that's what I want. As a trader, I need that movement, and it's a lot easier to see that movement outlined in NQ versus something like the S&P here. I can see, even though the muddied waters of the decoupling this morning, we still were able to ferret out, certain aspects of price. But it's not enough to warrant an entry because just because you got in a trade, who cares if I would have got in here on that? Who cares if I would have, took profit down here or had a runner still that takes another partial out below that low? And if it delivered, who cares? It would not mean anything to me as an educator because I've already outlined it as it's a decoupled market. It means it doesn't have the highest degree of probability. And as an educator, I'm trying to teach you to focus on those circumstances, not just simply because, oh, there's a PD array and there's a liquidity pool. So let's couple those together and just throw anything at the wall and see what sticks as a short. And then you wonder why you're getting chopped up, your account being ground down, blown accounts, failed combines, failed funded accounts, losing real money, and then failure. It's because you're forcing things in conditions faster than you should. In other words, you're taking a leap of faith when it doesn't warrant that. Whereas if you had a lot of things going in your favor, where all the indices, all three were in agreement, they were moving in the same direction. We traded back to the first presented fair value gap, and then it showed displacement after that. Then it's easy. We could drop down to a 15-second chart and take the very next fair value gap and trade, in that direction. It need not be complicated. But what does make it complicated is you wrestling with your emotions and your impatience because you just simply want to get in here and do something. Especially if you've never made money or a profitable trade, even in demo yet, using the material I'm teaching. You're rushing to get to that one moment where it worked in your hands because you're telling yourself, if it does this, then I will be able to stick with it, because it's hard to learn how to be disciplined. It's hard. It's not hard to learn from me. If anybody gives you really specific rules and a lot of limitations, to say it that way, it's going to be hard to learn under that. I'm looking at this little gap right here. Yeah, should be rolling over. Really ugly. Really, really ugly. But one of the things that I've appreciated as an educator in this year's mentorship lectures is the feedback in the comments. I see all of your comments, by the way. Some of you are doing it very smart by taking and leaving little timestamps for things for your notes. No one else sees them. I can see them, but you're using the comment section on the 2024 mentorship videos as a way of annotating it like it's your own personal journal. That's the right way of using my comment section. Okay, um, but I see every comment, every single one of them. The really long ones, I generally skip over them because I don't have time to go through all that stuff. And I'm sure they're very nice comments or whatever, but I don't have time to read that kind of stuff. So, but usually the real short, to the point, thank you so much, or could you talk about this, or I didn't understand that. I use all those things to kind of like go into the discussion points in my next lecture, or if I come back around and talk about that topic again, I'll pull from my notes any like bullet point things that I want to kind of like ring into the conversation. The uh, the feedback of knowing when to sit still, because the folks that are being honest and saying that they have had difficulty initially, and now they're becoming a little bit more responsible, and they're admitting that their results that were adverse initially was due to their impatience and then trying to do something too fast before they understood what they were doing, and also forcing my concepts in conditions that I, as the author, would never do it. Like, I'm explaining today what it is that makes this morning a little bit more problematic. It doesn't mean it's impossible. It just means that it's going to be harder for you as a new trader, new student, to navigate it. Hey, hush. So let's take a quick look at Dow once more. Scout's always got a, her name's Scout, S-C-O-U-T, not Scalp. like Boy Scout, like snipe, Scout Sniper. That's basically what I remember after. She's always got to show herself, don't she? Hey, little girl, hush it up. You had your cameo for this morning. And look at this price action. Compare that with what we just saw in the Dow, and then now the NASDAQ. Bear with me for 1 second, okay, because I'm going to have to shut her up. Sorry about that. All right, so I'd like to see if it can come back up in to the range here. It's done enough exploring for me. If it wants to go back up in here, I would like to see it come back and trade back into the opening range gap. Would not want to short it. Would not be interested in chasing it lower. S&P is shrugging off any willingness to want to go lower. So look at the low here at 951 to present. Okay, and then look at the NASDAQ. Lower in NASDAQ, which is what we expected anyway. We wanted to see the NASDAQ lead to the downside. But the S&P I mentioned earlier, I said I'd like to see if it's going to show an unwillingness and kind of like shrug off any weakness. We've seen that thus far. So in other words, the S&P has not been wanting to go lower, and you can already see how it's showing its willingness to want to go higher now and not go lower. Focus in here and over here. And then the minor one is here. And the Dow, still wanting to do what it wants to do. The old brat. All right, and I think we're a little too far extended to want to come back into this. I mean, it can, but I wouldn't demand it. And now this one right in here. Remember I was telling you earlier that could end up becoming an inversion fair value gap if we were to trade back into the range after breaking out below to the sell side, we've seen so far over here. Now sell side resides here. Like that. And what we want to see, what I would rather see is Dow continue doing what it's doing, going higher, or consolidate, not drop. Let me go back into the Dow. Dow either stays going higher or consolidates and allows ES to hold its ground, not break below this low. We don't want to see that. And notice this wick that I was drawing on, this consequent encroachment. It stopped it here, traded back above it, and then the bodies, consequent encroachment of this wick, and then the low of that candlestick right there. You see that? And then this volume imbalance, we traded through it, and look what happened right here. The body stopped on that high of that volume imbalance, and it stopped on the body right there at the open and started rallying. And it went down into it, but didn't breach it. See that? It's interesting, isn't it? Back into this fair value gap, but the liquidity rests here. So it doesn't make any sense for it to come all the way up here just to get to that. It's already shown it's not wanting to go to its own sell sign, which was down there. So far, even though it's decoupled, if you're going to want to listen to this again, even though it's not an exciting lecture, it's teaching you visibility through this chaotic decoupling between the three averages doing all different things. I'm pulling out the things that are salient, what would be catalyst for the market to see it back into its range. The S&P would shake off any weakness. That means it sets the stage for what? SMT divergence, which it was not willing to make lower lows here. When the NASDAQ was able to make lower lows. And now we're trading up into this gap here. So we want to see, does it want to trade? It can accumulate in here and run right out of that. That's one of the caveats to an inversion fair value gap. If a market's extremely strong and you're expecting it to perform like I've outlined here before we even move back up into it, I said once we hit sell side, if the ES fails to shrug off, I'm sorry, if it fails and shrugs off weakness, that means it fails to drop down, which is what we've seen so far. Then this could become an inversion fair value gap. And then we watched the NASDAQ create lower low, but then the ES failed to make a lower low at the same time that the NASDAQ did that lower low, at the same time that the Dow just keeps going higher. So the way these indices could come back into agreement and become symmetrical is Dow stays consolidated, don't lose any ground, don't go lower, or keep going higher, and then ES fails to make a lower low, and that's what we've seen so far. NASDAQ makes the lower low and then comes back into its range and uses this as an inversion fair value gap. Now the caveat is it can just leave this thing and never come back down and touch it and use it as a discount array. So that's why sometimes if I'm really convicted on the idea that I think the market's going to go higher in this instance, I'd be taking the trade as it's hitting this candlestick's high right there, or trading right at this point now because it's in consequent encroachment. I'm just going to highlight the midpoint of it, so that way it kind of like highlights the halfway point. In instances where it's really bullish, it affords me to get my first 6 contracts on, and I may not get my 4 contracts if it comes back down and touches the high of the gap, which is this candlestick's low. So that's why many times if you look at my examples, I'm entering inside of an inversion fair value gap before it actually proves itself to you as my students, because I understand a little bit more what I'm looking for. And I've also had instances where it just runs right out of the inversion fair value gap and I don't get either my fill or my second partial to build into a pyramided position. So it's kind of like a knack thing. I don't have any rules that I could adequately explain to know when it just runs away from the inversion fair value gap. It just happens. Kind of like the same thing we've seen here where I identified for you the first presented fair value gap, but it didn't deliver to it as a short. Okay, well, because it dropped lower, we watched this thing pretty closely this morning. We called out the S&P potentially shaking off any weakness, and then the Dow keep going higher. So we have a decoupled market, and we were able to still see certain aspects in what price is likely to do. It doesn't mean it's going to always do it. I get it wrong a lot when it's decoupled. Don't think for a second I'm trying to sell you on the idea that I'm 100% inaccurate when there's a decoupling between the 3 averages. When I say it becomes complicated and complex for precision, I mean it, because there's a lot of things that would otherwise be in play that I could point out to and say, well, look at this and look at that, look at that. We're seeing a lot less of that here. There's enough of them, obviously, for you to scratch your head and say, wow, there really is something to this. But it's not enough for me to feel convicted enough to get in there and press the button and enter with real money. That's kind of like what I'm trying to get at. So just know that if you're feeling the impulse to want to send me a comment about, can you teach us how to know when it's never going to come back to the inversion fair value gap? I don't have a way to articulate that. I don't know how. That's a limitation on me as a mentor. I just don't know how to teach that. And there's a lot of things I have those types of things with that I'll never. They're like taboo conversations where I'm never going to bring them up, because to do so or use them in a trade idea and trade them, execute on them, and say this is my so and so. If I don't have a way of explaining it to my kids, I'm certainly not going to have it to explain it to you. So it's just one of those things I have in my back pocket, that it's an experience thing. It's something I've acquired over years of doing it, and it's not something that's an advantage. It's not an advantage. It's just a me. It's a me thing to justify why I don't have to have a return back to that inversion fair value gap, because my compensation is I just go in when I know I'm bullish. I'll just enter inside of the inversion fair value gap as it touches the candle that enters it, which is here. We saw that there. And I said, or I'll just go in at the consequent encroachment and look at the bodies of the candles right there. You see that? And then we've already delivered here. So this is right here more than most of the folks you see on live streamers, that they're trying to capture something like that. All live, explained to you, even in a little bit more difficult market. But these are the kind of lectures that I wish someone was teaching when I was coming up in 1992, because that would have really helped me slow down, and I would have not hurt myself as much as I did, because I was in a rush to try to make money and quit my job and get out of poverty, basically. I was living paycheck to paycheck with a part-time job and in school. So it was a wreck. All right, let's take a quick look at the Dow once more. Okay. And ES. And it runs to the buy side here. That's probably random. And then we would want to see it just for good measure. I'd like to see it go up here and smoke those highs right there. We could do that before 10:30, Phil. I'd appreciate it. It's a friendly request. And then back to NASDAQ. See how we just keep gaining ground, and we never came back into what would be viewed as inversion fair value gap. If you're extremely bullish, and what you've already outlined or anticipate as an inversion fair value gap, if you're bullish, and if you're really, really bullish, why would you wait for it to come away from it and then come back down? That is in a lot of ways, that is a slow to the dance party or last to the dance floor perspective. If you really want to get out there and boogie and get down, then get out there and get down. So if I know I'm bullish, once we enter this area in here, I already have the conviction that I want to see it, use it as an inversion fair value gap. So why would I give up the opportunity to take an entry at a very low price inside that inversion fair value gap, like at the top of that candlestick here, or at the mean threshold? Mean threshold, the consequent encroachment, which is the midpoint of this gap. And you can see the body's delivering on that basis right there. And that to me is, again, a signature that I try to press upon you as my students to say, look, what's the chances of that happening, where the bodies close and open of the second candle occur right at the midpoint? These are things that I keep teaching you to look for. And it's a farce for everyone to come out here and say that doesn't agree with an algorithmic price delivery mechanism or engine that delivers price. They'll say it's buying and selling pressure. And my question is how on earth did the buyers and sellers agree to allow the candlesticks that are time-based here, and the time-based candlestick is your advantage. These Renko things or whatever else kind of bars you want to call it, range bars, they are not going to give you the insight that the algorithm is literally never going to be able to hide from you. It's never, ever, ever going to be able to hide from you as long as you're utilizing the aspect of time first. And that's what an open, high, low, close or a candlestick with open, high, low, and close function is in charting. So if you're looking at price through the lens of this mechanism, you're never going to be lost. It doesn't mean that you're going to be right about everything you're looking for. It just means that you're never going to not be able to see what the algorithm's doing. But when they get in there and they intervene, you also can see that too. You can also see when that's occurring. You cannot see that with range bars. You cannot see that with Heikin-Ashi. You can't see that with all this other nonsense. These things, these gimmicks, they're all designed. I'm watching this little gap right here. I know it's hard to see because I've got my watermark on it. That little gap right there. I don't want to paint over top of what I already have here because I'm watching. Does it want to just spike into this and then try to continue on? Or does it want to use this order block right here? I'm waiting to see if it can get up in the first presented fair value gap. That's kind of like really what I want to see, and I'm hoping it could do that before we close session. But if it doesn't do it by 10:30, I'll leave you with my comments before I close the stream down. But this is enough. This is a profitable study so far because we're working in a problematic condition. You're not going to hear a live streamer explain to you what's going on, why the markets are decoupled. They're not going to explain to you which market's going to behave a certain way, which one's going to fail to make a lower low, and which one is going to make a low and come back in the range. That's exactly what you watched me do today. There's no way around that. It's exactly what you watched me do. I've explained it. I gave you details. I tried to be very succinct about it today because I had a lot of fun yesterday, in case you didn't notice. But I wanted to be a little bit more academic with you today. And based on what we were watching this morning, it gave me a wonderful stage to do that because you got to know how to trade if you're going to navigate these types of markets like today. If you don't know how to trade, you're not going to know what I'm telling you. You're not going to see it and know that, okay, this is not something I want to be participating in. And that's experience. And most of these live streamers, they don't have that kind of experience. No knock against any of them, really, but they don't have it. So we're back inside that order block I was mentioning right here. Still could come right back down in and hit that inversion fair value gap. It's not out of the realm of possibilities. It still can do that because there's a little gap in here. But preferably, I'd like to see that stay open. If I could see that stay open, that would fuel a run higher than the first presented fair value gap and the gap closure. And then it's even here, but more so back to this buy side there, that line. And despite everything that's been outlined here, I have absolutely zero interest in being in the marketplace. And couple that with the visibility, knowing what I'm looking for, even though it's something I'm not willing to trade, still being able to anticipate what is likely to happen in price on a 1 minute chart where it's supposed to be just noise. Remember, Goldman Sachs guys, these alumni from Goldman Sachs, they're going to tell you that there's no rhyme or reason why the market's going to go up. No one can tell you, no con man can tell you when it's going to move or how it's going to go up or where it's going to move to on these lower time frames. But they're going to say only higher time frames work. Price is doing the same thing on the higher time frame chart that it's doing on a lower time frame. It's not a different price. It's the same price. It's behaving the same way. Whatever price is at the market at any given moment, whether we're looking at a 1 minute chart, a 30-second chart, a 1 second chart, a weekly chart, it's still the same price. And these are Goldman Sachs boys that are telling you that. These are supposed to be the elites. They're not elites. They're not. And you're seeing that there's literally no reason to believe these type of people that tell you. They try to discourage you when you're trying to learn how to time the market correctly. And there's a way of doing it. I mean, I've proven it. I have very, very wealthy students now that came out and they proved it and they have the receipts and whatnot. And they're using the same logics you're learning right here. And they're getting more detail at the same time you're learning it too in this 2024 mentorship. You're getting to see it over live price action. This is exactly what I was doing with mentorship students. And it's fascinating to see how some people don't see the value in it, because this is exactly what I wanted, but I knew it didn't exist when I first started in 1992. No one was willing to do this. Not one person was willing to do this. And I guess in all fairness, I guess we really didn't have the technology at the time to do it. I mean, I guess the best thing it was is that we had message boards back then, and we had chat rooms. Okay, great. And it wasn't like this where we can literally share the screen. I can comment, or they could comment over their charts live and build an idea around what it should behave around, what should it do next, and why should it do this, and why should it not do the other things. And you can't get that from a book. Okay, you can't get that from people. Even if you go to like a workshop or a seminar, most seminars are always generally held on weekends, where it protects the teacher from never having the accountability and the responsibility of proving it over live price action. And I've never been a fan of that. And there's a lot of well-known quote unquote educators out there that did all these types of workshops, these 3-day workshops or 2-day weekend workshops, where you have the built-in parachute protection of never being held to, well, tell me how that would be used or seen in price action live. They don't have to do that because it's on a Saturday and a Sunday, right? Or in a Friday evening where you have a nice dinner experience with them. Yeah, screw that. I don't have that. I don't have any interest in that. Because if you're not willing to get out here and explain it to me real time over price action, give me a little bit of time. You don't have to do it, for a whole year. You ain't got to do it for 6 months, but give me a couple months at least. How about a month? Sit down and explain the logic of what you're looking for in price action. And here I have been doing it with you all. And still I had students that said there was no value in it. And that tells you that they're not willing to learn. They wanted signals. That's what they wanted. They wanted to see signals generated. And the first thing you have to learn is capital preservation. Knowing how you're going to lose money, in what type of market environment you're going to lose money. And if you can't recognize that, you're not going to recognize the increased difficulty in you applying the things that work in good markets. Because the complexity of having a market decoupled and you trying to be demanding of precision elements that may elude you, not because my concepts don't work, it's just because you're literally trying to run in mud. It doesn't work that way. So you have to be a little bit more reserved and say, okay, I'm not trying to force a trade, but I am going to watch price action and see if these things that are being outlined are helpful. Are they indicating anything in terms of prognostication? Did you see the ES? Let's go back to it real quick. Did you see the ES shrug off its unwillingness or not want to go down to its lows here? It showed an unwillingness to do that, as we indicated this morning. And it would run for the buy side here, and it would run over here to that. Now, only a fraud could tell you this beforehand. Okay, I mean, union rules, as the committee tells us, every fraud has to tell you in advance exactly where the price is going to go on very complex days. We have to do that, because if we don't do that, we can't be kept in the union protection. Okay, it's just the union rules. It's something we all have to do, folks. It's just the way it is. I can't do anything about it. But when we go back to the NQ, make that in your documentary. We have the market making that lower low in NASDAQ, as I indicated, would likely do after it took its initial sell side. Remember, it was a little bit higher up here. It went down below it, and then I wanted to see it trade back into its range if ES failed to make a lower low. So what did I do? I forecasted a SMT divergence before it happened. I told you that we would see it return back into its range and come back up into the first presented fair value gap. And thank you so much, Phil, for being a gentleman today, allowing it to happen before 10:30. And we're back inside the opening range as well. So what I would like to see it do is just power on higher up and punish those that are short, that have their stop loss sitting right there. And if they're going to run that high, then it's reasonable to anticipate that little Lego looking area price action I was mentioning earlier. I got disoriented here. I'm trying to remember where I saw a little tiny little segment of price action. It was a little too boxy looking. Uh, anyway, the key takeaways today are simply this. You're learning from somebody that knows what they're talking about. And I do a lot of things online to stir up a lot of commotion because it's my way of bringing traffic to my channel because I don't advertise or pay for advertisement. I never do that. I manipulate the viewer's mindset so that way you're going to argue about defending me or not defending me, or you're going to troll me. And because you're talking about me, you're going to bring people to my channel and they're going to watch me do things like this. And then they're going to be stuck in a quagmire because they're going to either listen to your opinion that's biased because I gave you that opinion because I manipulated that. I put you in that situation to make you feel empowered so you can make videos about me. And then the people that watch your videos, and you get paid for that, okay? But I'm not paying you. But you're going to send those viewers right to this channel. And they're going to watch me outline this stuff in advance. And there's going to be a question in their mind. Either I'm time traveling, I'm using delay data if they're watching the stream later on and they're not here live. But there's so many people here watching it live. It's undeniable. I'm on the lowest latency on live stream on YouTube. That's why they don't let me have the closed captions, because if anyone wants a live stream and test it themselves, you'll see that you cannot do closed caption when you're using the lowest latency. So if I'm going to be talking to you over a 1 minute chart or less than a 1 minute chart, I'm going to use the lowest latency because I want you to see there is no delay. Okay, I'm not using a delay chart. I'm not defrauding you with fake delayed data and using market replay. I'm not doing those things, folks. I don't need that. I don't need a handicap like that. So the main takeaway is this. I know what my algorithm is going to do. Yes, it's mine. Okay, it's very straightforward, isn't it? Okay, it's the time to put the bullshit aside. It's mine. It's got my fingerprints all over it. Mine. Okay. When I talk to you, I'm talking to you as its coder. Okay, as its author, as its designer and engineer. I am the man. I am the motherfucking man. Whether you want to believe it or not, I don't give a shit. I don't care. If I'm not allowed to sit at the table, I'm going to make more of me. Don't you get it? I hope you guess my name. If I can sit here and tell you what the market's going to do and what market is going to do this and what market's going to do that before it does it, and then it behaves a certain way and it delivers, and I tell you, an inversion value, fair value gap that was going to form here, it may not come back down and touch it. And you're looking for it to come back down and trade there. I'm telling you, I'm going to enter it right there as it touches that candlestick's high. And if I don't get that price, I'm going to get the consequent encroachment. And then it runs away. Does it ever come back down and touch that? No. I told you I wanted this fair value gap to stay open. Why? Because that would be a breakaway gap. It leaves this PD array, and if it's breaking away, it's not going to come back down. It could have done that, and then I would say that would be an entry point right there. But I said I would prefer it to stay open. And I told you I wanted to see it trade back up into the opening range gap, which are these two blue lines here. But more specifically, I want to see it trade back to my first presented fair value gap. That's what it's coded to do. That's why it's there. That's why it's designed to be there, because it gives me an edge. It gives me the advantage that none of you ever had. None of you ever had that advantage. None of you ever had the ability to sit down and know exactly why it should do and why it should do certain things. You've never heard another person ever sit here and talk to you with the authority that I do. It's never happened. And I'm doing it over live data. So there's no joker that can come around and say, oh, well, look at this and look at that. Look at everything. I want you to look at all that stuff and come right here and watch me operate. That's what I want. I love placing you in the hot seat where you're forced you have to admit it. You have to admit it that you're not seeing anything in retail here. You're watching someone that knows exactly what's going to happen. Period. And now you're left with another testimony of that. You have to arm wrestle with how I knew how to do this today. How? How on earth could this possibly keep repeating every single day? Every single day. And you're out here wanting to send money to these other people that are literally resetting their funded account challenges in front of you. And they're making money off of you while failing in front of you, not knowing where the market's going to go. But they have an opinion about everybody else. And I'm literally laying this in your hands for free. For free. There's no future mentorship. I have nothing dangling. There's no carrot. There's nothing here but just the simple truth. I told you who I was from the beginning, but you don't want to believe me. How many times do I gotta keep doing it? How many times do you have to keep seeing me do these things before you recognize who I am? Think. Think, folks. How many times do you have to see this? It's delicious. So there's a lot of things that you're going to be met with on days like this. And you're going to expect to see certain things pan out if you don't recognize the decoupling. And the decoupling, again, is the unwillingness for all three averages to move in the same direction. Okay? And as soon as you see this, this is what you want to write down in your notes too, because I didn't mention this earlier. As soon as you notice that there's decoupling between the three averages, where the Dow was going up initially, let me do this because I really want to be able to show it to you. All right, so let's do this. All right, so here's the NASDAQ chart, and then we're going to put the Dow here. I'll save this part, and then I'm going to close it. I know you want me to keep going. I'm like the Energizer Bunny, but I've done enough for today. I want to take care of some personal matters. I'm trying to find Del Monte sliced carrots, and I don't know why I can't find them. Every store I go to, they don't have them, and that's my preferred carrots. But I'm not eating a raw carrot for food storage. I prefer that one, and I don't know why I can't find them. If you know where I can get some, I'd appreciate it. But I'm on a hunt for Del Monte carrots. So here is the ES. Here is let's 1 minute chart on that. The Dow. Yeah. Okay. So we've seen at 9 o'clock this morning, the ES, it drops down. At 9 o'clock in the morning here, we have a little bit of movement lower, and then the Dow says, oh, absolutely not. I'm not interested, and starts going higher. At the same time, the S&P was going lower. And at the same time, we see the NASDAQ dropping down, okay? In all this mess here, because there is no symmetry, meaning that the Dow was going one direction, S&P was going lower, and NASDAQ was going lower. That's fine. How can I still read the NASDAQ like I did? Because I had the coupling that still existed directionally with the ES. I don't care so much about the Dow. The Dow tells me I'm in a decoupled state. That means I'm going to lose a lot of precision. That means I'm going to lose a lot of resolution in visibility of reading price action in my NASDAQ. And I'm definitely going to have a lot of resolution issues in the ES. It's going to cause like a fuzzy, out of focus picture. Even though I can see it's likely to keep going down, and I told you, and listen, you're going to go back and listen to the stream and hear me say this. I want to see ES shrug off any willingness to go lower by shrugging off weakness. That means a failing to go lower. If it fails to go down, take its sell side. That's what I want to see. I'm waiting to see that. That means if I'm expecting the NASDAQ to go lower, that's going to do what? It's going to create an SMT divergence. That means it's going to fail to make a lower low on ES when the NASDAQ does make a lower low. And then the NASDAQ will go up back into its range and trade back to its first percentile fair value gap. Tell me who called that. Tell me, all you ICT mentorship guys out there that are trying to teach my stuff, tell me that you can go out there and do this. Tell me. Because if you can do these types of things, then you earn the right to teach my shit. Because you can't do these things. You didn't author it, you didn't code it, you didn't design it, and you didn't put it out there. Period. Simply that. You don't know what the fuck you're doing. So stop selling my shit. You don't have the right to do it. Okay? And all you guys that have your channels up there with my shit, they're teaching it. Have you noticed I'm taking those channels down? Yeah. How about that? You don't have the right to put my shit up on your channel. Period. My videos are my lectures. Stop uploading my shit and putting them in your language because they're getting stripped down. And don't cry to me about, oh, could you take the copyright strike back? Fuck you. I'm not taking it back. You don't have my permission to do that. I predicted with the logic explained to you in this live stream why the SMT divergence would occur. In which one? The ES would fail to make a lower low. It would shrug off weakness. I knew that was going to happen. This is what you're writing down in your notes. When you see decoupling, and generally you're going to see the Dow become that little brat. That's its usefulness to me. I don't care that if the Dow makes a lower low and the S&P fails to make a lower low. I don't see that as a divergence. That's not, to me, that's not SMT. Because I know that the 30 stocks that make up the Dow are not that impactful overall, but they will normally bend to the will of both the averages when ES and NASDAQ are going lower. It goes without reason. It goes without saying that all boats rise in high tide and they all go they drop in low tide. Okay, that's the analogy here. So when it's really, really moving, the Dow should be moving in sympathy with the ES and NASDAQ. But if in the morning session we open up and it starts doing like it did this morning, that means I already know that I'm going to have visibility issues with the precision. So then I have to go back to, okay, that means that we're decoupled. So at some point later on in the session, there's going to be a SMT divergence and they're going to go back in sync. The Dow is simply telling me, no, we're not going down there right now. So I'm going to be looking for what? I'm going to be looking for the S&P because this one's going to be fuzzy compared to the obvious imbalances and stuff that we saw over here that I annotated, and you can see the prices reacting off of. We're seeing a lot of overlapping in here. Let me magnify this one again. We're seeing a lot of the give and take, back and forth delivery of price here. Every candlestick, the range keeps overlapping with the previous one. There's a lot of revisiting of the same prices. So this is like fuzzy type of price action compared to, see how much more nice and refined every little range. We are able to see the bearish fair value gap here, the change in the state of liquidity, bang, hits it. The body stayed inside the volume imbalance here. We have a volume imbalance here. The body starts in there and leaves it. Doesn't come back up into it. That's weakness. Drops down. I told you this is going to be an inversion fair value gap, but I also said it may not even come back down and touch it. And I told you how to use that inversion fair value gap as an entry, how I would use it, and how I would use it to make sure I get into the trade because I may not get that, which didn't come, the return and reprice back down into it. And I told you I want to see that fair value gap stay open. That would be a breakaway gap, and it would take us right back up into, what is this? Oh, look at the bodies here respecting the first presented fair value gap. That's completely random, isn't it? No, it's fucking coded to do that. Hello, and you think it's buying and selling pressure. It's unbelievable. It's literally unbelievable. The volume imbalance that I annotated over here, because this is all part of what? What is this? What is this right here? Market maker buy model. Does the market maker buy model have to come back up and clear out the original consolidation? No, it doesn't. It does not have to do that. But you have to know where it's going to draw to, and you were told that. So the volume imbalance here, it trades above it, comes back down, a little tiny little bit outside of it, comes right to the top of it, and then sends it right into the promised land, the first presented fair value gap. That's always been in your charts, but you've never noticed it. Why? Because Wyckoff didn't teach that. Because Elliott Wave never even heard of it. Pitchforks, don't even get me fucking started. I stuck a pitchfork in the market's ass today, right in front of all of you. It literally was laid out in front of you perfectly. In a hard market environment, where everybody else out there is going to be scratching their head saying, wow, I'm trying to trade ES, it's a mess. Oh, wow, I'm trying to trade Dow. What the hell's going on here? This is going all over the place. It's a mess. It's a mess. And maybe you were in the NASDAQ. Maybe you were. Maybe you were trying to trade short on this first presented fair value gap, and you're scratching your head thinking, oh, they changed the algorithm. Does it sound like I changed a fucking thing today? No. Nope. Didn't change anything. Everything's the same way. It's going to be the same way. Until these markets no longer exist and you're not allowed to trade in them, you're going to see these things in effect, period. This is the way it is. You don't have to believe me. It's actually better if you don't. This means there's an immense supply of liquidity because that means you're going to be on the other side of my fucking trades. You're going to be on the other side of my students' trades. Either you're there in the train of thought that I'm teaching and you're not being cannibalized then. You're not going to fall victim to this stuff. You're not going to be tricked and deceived by price action and thinking about the market runs off of bull flags and bear flags and cup and handle patterns. And that's horseshit. All that stuff is nonsense. It's literally nonsense. And the sooner you come to the realization that these markets are fucking rigged and they're to the tick rigged and it's time-based delivery, the sooner you're going to be to where you're trying to be, which is consistently finding setups that yield profitability. But that's a huge leap from your first endeavor of trying to learn how to do this, whether it be with me or someone else, to getting to that point. Because you have all these things in your head that you're rushing to try to get done. I want to be profitable right now. You can't be profitable right now. You have to learn how to fix yourself. And in a day like today, this is a complex day for someone that doesn't know how to trade. It's very difficult. And I have no shame in saying that it's a more difficult day. Obviously, you can see what I'm talking about is happening in the chart as it happened in real time on a 1 minute basis. So it's not that I don't know what I'm doing, but I'm agreeing with you if you feel that the adversities in environments like this, because it makes you feel like you're somehow ill-equipped mentally, or you don't have the capacity to learn how to do it because the market feels like it's always beating you down. It's just you're trying to force something in an economic climate that we're in front of an election that's historic. There's a whole lot of corruption everywhere. The markets are absolutely rigged, and they're doing a lot of things right now in the last 3 years that they've never done before. They've never done these types of wild whipsaw, but then get right back in the sink again. There's a whole lot of hand involvement in this, okay? And if you've had a lot of difficulty in the last year or so, or you've made lots of money, but you just barely made some money, it's not technically your fault. It's not technically your fault. And if you can just accept the fact that you can learn this given enough time, as long as you don't force it too fast, if you're not trying to be correct about everything, you stand a better chance than you probably given yourself the scheduled destination goal that you've created for yourself, because you have a time that you want to be profitable, and you can't do that. Because as soon as you set a date that this is the day I'm going to quit my job, because I did that stuff. I did that. I have so many deadline dates that I was going to quit my job, and I had to keep pushing that date further in the future because I was setting a date that I was going to quit my job. And when it came to, I don't care about that. I need to learn how to do this and know that I'm comfortable knowing what's going to happen in the marketplace. And then if I could see it, if I could create these advantages that are going to be outside the scope and reach of everyone else, then it's a lock. I'll know it when I know it. And that's the same thing for you. It's the same thing with when you want to trade with real money. When do you migrate from a demo account to live trading with real money? I don't know that for you, but you're going to know it when you can sit out in front of a chart, not in front of me or anyone else like I'm doing here. That's not necessity. But when you sit in front of the charts and you can see what it's going to do, and you're not swayed, you're not feeling impulsive that I have to get in this trade because I feel like I'm going to be right and I need that scratched itch. I need to feel good about something. When you're no longer replacing something that you're feeling in your job, your personal life, your relationship, that void of discomfort or unpleasantness or lack of happiness, if you're not looking for your trades to reward or fill in that place in your life, and you're consistently able to see what price is going to do, when you're not being swayed from outward influences, me, anyone else online, anything, but you can still see what price is going to do, and you know how to enter it and where your stop would be, and you have no emotional stimuli around the outcome of it. That is the surest way to know that you're ready for trading with real money. Because if you trade any time prior to that, I promise you started too soon. And you're probably going to blow your account, or you're going to have a whole lot of drawdown, and then you're going to create scar tissue, and that makes it so much harder to do it with real money. I made those mistakes in 1992. I started literally a month after reading a book. That book was not even good. And I blew out half my account in the first trade. It was an option trade in orange juice, and a lot of you know the story. But that created such a fear. And I'm teaching you in this mentorship, the same way I'm teaching my son, is to sit out here and engage price action with no monetary link to it. None whatsoever, none. He tried it again. He failed his top step. He got it. He passed it, but he lost it because he's trying to do before he should simply learn how to do it. All he's doing is confirming how I'm teaching is the correct way in this mentorship. The making money part, that's the easy part, but that you have to arrive at the right mindset. And if you force trying to be profitable before you're even equipped mentally to be able to do it, you got to be able to say no a lot more than saying yes to a trade. And you'll never hear a teacher or an author of a book say that. There has to be more instances where you'll say as an analyst and trader, no, I'm not interested. Even though you can sit there and say, it's going to go here. It's most likely not going to go here, but it's going to go here. But no, I'm not entering that trade. See, to a new student or to a jackleg online, that sounds asinine. That sounds counterintuitive. It's like, well, who would do that? That's someone that's unprofitable talking like that. But someone that says no frequently and says yes to high probability conditions and setups, that's a person that's going to have a long career. It's going to have longevity. It's going to be consistently profitable. They're going to have losing trades, but their losing trades are not going to cause them to tail spin and go into full tilt and blow their account. That's the characteristics that make a stark contrast between someone that simply says, I'm a trader, I've made money, look at this, but they're only showing you those instances where it's worked. They're not showing you that they've never had any profitability the rest of the time that week. They're only showing you those those single hits. Here it is, here it is, here it is. And they're hiding and avoiding all that stuff. You know who they are. They're people that show screenshots after the fact. They don't even have a stop loss in there. Come on. We're past all that now. We're past all that. I'm so happy to be a mentor that has encouraged other people to record their trades with a stop loss and managing it. And if you can tell who's learned from me, it's like a badge of honor for me to see people on the internet and they're recording their trades. They don't need to have anything annotated on their chart. I already know they're my student. I already know how they're entering, the fact that they're even recording it and the things that they're pointing to as where it's going to go to next. It's a dead giveaway. It's a dead giveaway. And I'm so glad that it's my students that bring that. You don't see all these other people in these school of thoughts doing that. It's an ICT characteristic. It's a thing that's rubbed off. It's in your DNA. Daddy gave that to you. Okay? Well, we can walk out there and prove that we can manage the trade from beginning to end with a stop loss over and over and over and over and over and over. Every single day, it's going to be there. Every single week, it's going to be there. But in the beginning, they're not all for you. They're all learning opportunities. They're all for your edification and your learning. But in the future, you're going to see that there's going to be a whole lot less trades that you're going to be taking. So you think that I'm taking thousands of trades in a month. I'm not. I'm not doing that. I'm looking for the ones that are just the easy, slow ride in with no adversities. It's low resistance liquidity runs. I don't have any static, no friction. It's just a slide on in. There it is. Thank you. That's what you want as a trader. But I had no one define that for me when I was first starting in 1992. Like, I didn't have that. I had Larry Williams telling me to watch accumulation distribution, Williams percent R, overbought, oversold, and look for swing highs and swing lows. That was it. And open interest declining when we're in a consolidation. So if there's a premium between the nearby contract and the next month out, then it's probably going to be a commercial bull market. And I was spending my time looking for that stuff. And all that stuff works if you're working on a daily chart, but I don't trade on a daily chart. I trade intraday charts because I want to be in there using velocity. If I go in there and take a trade on that is meant to hold for 3 months, 6 months, how much can I really get out of that move? Like I can't really do much more than what it's offering, because at some point you can over leverage to the point where you can't afford to trade any more contracts. And I'm not a fan of new equity building in pyramid positions in that too. I hurt myself doing that in the 90s. So here in lower time frames, I can roll an account over and over and over again with multiple setups, and the velocity of using new setups with new gearing, using the new equity at a new trade entry, that velocity can parlay the account up faster. When these other people out there are holding on, these hodlers, these hold on for dear life people, that doesn't make any damn sense to me. Okay, because if you know how to trade, you can go into any given time frame and roll and roll and roll and continuously build up, build up, build up with new positions. And as you make new equity, you're never risking any more than your fixed percentage of risk. So if you have adopted a 1% risk model, that means every trade you take doesn't go over 1%. As you make more equity, you can afford to control more contracts or lots if you're trading with Forex. So the risk is never increasing percentage wise, but because your equity is increasing and your ability to allow velocity in the acceleration of the equity growth, that's why intraday trading, and that's why high frequency trading is the mechanism of these entities. That's what they do. They don't go out there and buy and hold for long periods of time. That's not what they do. They work inside these fluctuations like this. That's what a high frequency trading algorithm does. It's buying and selling all day long. But it's using a lot of the things that I'm showing you here, and they repeat over and over and over again. And I would love to talk to you more, but I gave you another, what's that, 22 minutes more than I should have. But it's extra, and I didn't have to charge you for it. So I'm going to close this one here. I've had a lot of fun sitting down with you today. I hope you learned something. I hope it was able to guide you through this morning. I hope you didn't hurt yourself and it came away with some more insights. If you like what you learned today, I appreciate it. Give it a thumbs up. It doesn't cost you anything. It doesn't make me any more money or make any less money. But if you like these kind of lectures, it's a way for you to sound off and say, you know, I'm paying attention, ICT. I heard what you said today. I watched it unfold today, and I was a witness to it. So until I talk to you next time, I don't know if it'll be tomorrow morning. Let me just say that right now. I don't know if I'm going to be doing an afternoon session or if it's an AM session. So grant me a little bit of flexibility. I'll let you know early on tomorrow, probably like 7:30 or so, if I'm going to be live streaming the morning session or the afternoon. I have to determine what my personal schedule is going to be like tomorrow, because there's something I have to get done, and if I can get it done today, I'll be able to trade tomorrow, or live stream in front of you rather. And then if I can't get it done today, then I'm going to be doing that tomorrow morning. That would prevent me from being live streaming the morning session. I would then defer it to the afternoon. So we'll have to play it by ear. So just afford me that much latitude here. So until I talk to you then, Lord willing, be safe.